Welcome to the deep dive. So we have a source here that paints a fascinatingly specific picture of market risk. It's built around this metaphor of a circular firing squad.
Right, and the prediction isn't a quick 2008-style crisis. The core idea here is a slow, grinding halt, a capital expenditure freeze that basically stops the future cold.
Okay, let's unpack this. The source identifies three huge leverage sectors in this squad. They're all interconnected. First up, you have MicroStrategy and crypto. We'll call them the engine. They're providing the liquidity.
Then you have private equity and private credit, who are the banker, hand out the loans.
And the third player.
That's the builder, AI infrastructure, the data centers, the GPUs, the ones spending just massive amounts of capital.
Okay.
And the thesis here identifies a really specific regulatory kill switch. It's set for January 2026. The idea is that this trigger causes the engine to seize up, and that creates a systemic liquidity freeze that stops the entire AI build-out.
So we have to start with that crypto engine. The source calls it Michael Saylor's infinite money glitch. I mean, that sounds a little like a conspiracy theory title. How does it work?
Well, the mechanics are actually pretty simple. It's a four-step loop. First, they issue papers, so MSTR debt or equity. Then they use that cash to buy fuel, which is Bitcoin.
And that purchase pushes up Bitcoin's price, which in turn boosts MSTR's stock price.
Exactly. That's the ignition. And that higher stock price lets them go back and repeat the cycle, raising even more money.
So what's the flaw? I mean, it sounds like a perpetual motion machine.
The flaw is that the machine isn't actually creating new wealth. It's just aggressively importing capital from the stock market.
And what's the practical result of that?
Dilution. Massive dilution. The company's share count has already doubled just to keep this thing going.
Wow.
So your piece of the pie as a shareholder is shrinking fast. The whole structure needs that constant upward momentum, otherwise it just fails.
Okay, so this whole mechanism is running hot, and this is where it gets really interesting. The source points to a specific signal, a specific date, the MSCI index ruling on January 15th, 2026. What does this ruling do?
MSCI is reviewing its rules. And if this ruling goes through, any company with over 50% of its assets in crypto will get reclassified.
As what?
As an investment vehicle, not an operating company.
And why is that the kill switch?
Because that ruling would forcibly eject MSTR from all the major passive indices.
The huge automated funds that just track the market.
Right. And our sources estimate this would instantly force those funds to sell something like $8.8 billion worth of MSTR stock.
All at once.
All at once. A forced selling event that would cause a structural dislocation, crashing the stock for maybe 50% overnight. The engine fails. The liquidity pump just stops dead.
Okay, wait. So the engine stalls. MSTR stock tanks. How exactly does that bullet make its way from the stock market all the way to an AI data center?
They share a critical vulnerability, what the source calls the shared lung of private credit.
The banker.
A banker. You see, private equity firms use the exact same private credit funds to finance both Bitcoin miners for their ASICs and AI data centers for their NVIDIA H100s.
I was stunned when I saw that in our notes, that former Bitcoin miners like Core Scientific and Iron pivoted to become AI data centers.
Exactly. But here's the catch. Their collateral for those loans is still tied to the value of their crypto treasury or their own stock price.
Ah, so when the MSTR crash tanks Bitcoin,
the value of their collateral evaporates. They instantly breach the covenants on those private credit loans.
That's the domino falling?
It is. The banker freezes all lending. That credit window for AI capital expenditure, it just slams shut. All those orders for NVIDIA chips get canceled. Construction on $100 million power plants just halts. The funding to bridge that AI revenue gap is gone.
So the core conclusion here is stark. The entire AI revolution, the builder, was effectively built on a single point of failure.
Crypto-backed leverage, all supplied by the engine.
And we connect this to the bigger picture. The source argues this won't be a fast 2008-style crisis. It's a capital expenditure freeze. It's a grinding halt where illiquidity just stops any future build-out because the money needed to cover today's expenses while you wait for future revenue. It's just not there anymore. So this raises a really important question for you to think about. What specific projects that are relying on continuous debt financing right now, whether it's AI, green energy, or even commercial real estate, are most exposed to this kind of grinding halt?